You've been sold a lie for 3 years in a row. Real estate experts promised you one thing: home prices will never go down because there aren't enough homes for sale. People who own homes are stuck with their low-interest 3% mortgage, so they won't sell. Prices stay high and inventory stays low for all time. They called it the golden handcuff theory, which said that there was no way for the market to correct itself. It looked like it couldn't be broken, up until now. That barrier didn't just break in early 2026. It completely fell apart. And one important piece of data is flashing a bright red warning sign. The same sign we saw just before the housing crisis in 2008. We're re-seeing active inventory skyrocket while pending sales drop to all-time lows. For years, these two metrics moved in the same direction. Low sales because of low inventory, easy, but something scary is happening that we haven't seen since late 2007. Sales are at an all-time low, but inventory is going through the roof. What is the lock-in effect? It's officially over. Here's what no one is telling you about why this is happening right now. The lock-in effect is a good financial theory that looks good on paper. But spreadsheets aren't the only thing that works in real life. You might wait a year to sell your house because you do not want to trade your 3% mortgage for a 7% one. You might wait 2 years, but for good, that's not possible. Reality always catches up with you. Eventually, real estate agents will talk about the 5 Ds. Death is number 1. The years when baby boomers are most likely to die are now. When someone dies and their estate is settled, the people who inherit it don't care about keeping a low mortgage rate. They want to split up cold, hard cash. 2. Get a divorce. You can't stay with your ex just to save a little money on a loan. The house is sold so that everyone can get their fair share. 3. Debt. I've talked about this in other videos. Credit card defaults and auto loan delinquencies are going through the roof. Homeowners are being forced to sell their homes just to get some cash out of them and pay off their debts. 4. Displacement. Remember all the people who moved to faraway Zoom towns? They are being forced back to cities because of return-to-office rules. They have to sell. Number 5. Diapers. Families grow. You can't keep 3 kids in a small 2-bedroom condo forever. These pressures have been building behind the dam like water about to burst for 3 full years. The pressure is now too much for the lock-in effect to handle. People are selling because they have to, not because they want to. The numbers are terrible. In important warning markets like Austin, Cape Coral, and Phoenix, the number of homes for sale has gone up by 30% to 50% from last year. These were the pandemic boom stars. Now they're at the center of the collapse. Sellers are rushing to get out, putting homes up for sale at 2024 prices, only to find out that the buyers have vanished. Why aren't buyers here? The math doesn't work at all. Buying the average American home today costs almost 40% of the average household income. The average over time? Only 25%. It only got to 33% in 2006, when the last housing bubble was at its highest point. We've gone beyond the highest and lowest values of the great financial crisis. So why haven't prices dropped yet? One word: stubbornness. Sellers won't accept the truth because they look at their Zillow estimate from 6 months ago. They're still in the denial stage. They're giving every possible incentive, like lowering the interest rate, paying for closing costs, and doing free repairs. The only thing they won't do is lower the list price. But here's the truth: incentives are just price cuts that look like other things. Real price drops start when those incentives stop working. The percentage of listings with lower prices is already rising to levels seen in 2022 and 2008. The similarities to 2007 are really scary. The stock market was at or near record highs in 2007, just like it is now. There weren't many people out of work, just like now. The Federal Reserve kept telling everyone that the problems with subprime loans were contained. Does that sound like the story of a soft landing today? But the housing market was falling apart beneath the surface. In 2006, inventory began to build up, and it kept growing through 2007. Prices didn't drop right away. They got softer over time. They leveled off. The collapse didn't happen until there was enough stock on hand, usually 6 to 8 months worth. The floor broke then. National inventory is slowly moving toward 5 months right now. Some markets in the South have already been open for 8 months. The psychology completely changes when we reach that tipping point. Sellers freak out. They know that if they don't sell right away, they'll get even less tomorrow. They start to hurt their neighbors' businesses. This starts a race to the bottom that keeps going. Prices drop, which wipes out equity, leads to foreclosures, adds more inventory, and pushes prices even lower. It's a bad cycle that keeps getting worse. We also need to talk about how investors are leaving. During the pandemic, big companies on Wall Street like BlackRock and Invitation Homes, as well as many small Airbnb hosts, bought millions of homes. They turned housing into a gambling casino. But these investors need cash flow and leverage to work. Rental properties are losing money because insurance costs are going up by 50 to 100% in places like Florida and California, and property taxes are going up as well. That Airbnb that made a lot of money in 2022, in 2026 it's a money pit. The cap rate, which is the return on investment for housing, is now lower than the risk-free government rate. Why would an investor put up with tenant problems and maintenance for a 3% return when Treasury bonds pay 5% with no problems? They won't. They're beginning to get rid of properties. Investors don't have any emotional ties to the property, unlike families who need a place to live. To stop their losses, they will sell quickly. There are a lot of turnkey Airbnb properties coming onto vacation markets. Shadow inventory is turning into real inventory. The Federal Reserve is watching this nightmare happen, and they're scared. They know that for middle-class Americans, their homes are their main source of wealth. The wealth effect goes away if the housing market crashes. People feel like they have less money. They stop buying things. The economy is going into a recession. But inflation has the Fed in a bind, as I said in my last video. They can't lower rates enough to save housing without starting inflation again. If they lower rates to 3% to save housing, oil will go up to $150 and inflation will go up to 10%. The housing market will crash if they keep rates at 5 to 6% to fight inflation. They'll probably choose the latter, hoping for a controlled demolition of home prices. But housing markets don't usually go down in a controlled way. They break. The 2007 parallel isn't just about facts. It's also about feelings. Go to any dinner party today. People are still talking about how much their homes are worth. They still think that real estate prices only go up. They're still spreading the lie that there isn't enough supply. This is exactly how people felt in 2007. The most optimistic time is always when the trend turns around. The lock-in effect was the last line of defense. Someone broke in. The water from the flood is getting higher. People who bought homes at their highest prices in 2023, 2024, and 2025 are about to find out the hard way what negative equity is. They're going to go under soon. When you're underwater, you're really stuck not because of a low rate, but because you owe more than your house is worth. To really get a sense of how big the storm is coming to the American housing market, we need to look beyond the nice suburbs and into the crumbling heart of the financial system, commercial real estate. For the past 3 years, residential and commercial real estate have been seen as two separate worlds. The story went like this. While office buildings in the city center were empty and dying, homes in the suburbs were still worth a lot. This separation is a dangerous dream. Credit is what makes real estate a single, interconnected ecosystem. The disease that is spreading from failing office markets is poisoning the wells that residential real estate needs to survive. The vector of the infection? Banks in the area. These banks, which have between $10 billion and $100 billion in assets, are what keep American housing going. Big banks like J.P. Morgan and Bank of America deal mostly with businesses and credit cards. Regional banks, on the other hand, handle most of the work for real estate. They make 70% of all commercial real estate loans and a huge amount of money for building homes. They lend to people who build homes, people who flip houses, small landlords, and people who own businesses in the area who want to buy property. These banks are zombies right now. They're stuck in a death spiral of bad debt that they can't get out of mathematically. The office sector is at the center. Because of permanent shifts to remote work, vacancy rates in downtown buildings have stayed above 20%, and the values of office buildings have dropped by 40% to 60%. In 2019, the building was worth $100 million. Now, it's worth $50 million, but the loan on it is still $80 million. The landlord is in debt. They're giving the keys back to the bank. The bank now owns an asset that is losing value and making no money. When a bank loses $30 million on an office building, that money is gone. The bank needs to quickly cut down on its balance sheet in order to stay in business and follow the rules. How? They ask for more loans, they stop giving money to other people? This is the credit crunch that destroys housing markets. The death of the BRRR strategy is already showing us how this contagion works. For 10 years, BRRR was the never-ending money glitch for people who were new to real estate investing. It all depended on getting easy credit from local banks. You'd buy a house, fix it up, get it appraised for more than you paid for it, and then use the money to buy the next one. The cycle just hit a wall. Because regional banks are losing a lot of money on commercial loans, they have stopped offering cash-out refinances. They're looking very closely at appraisals. They want higher ratios of debt service coverage. A lot of investors are stuck in the middle of a flip with hard money loans at 12% interest. They can't refinance into cheaper long-term mortgage. These investors are being forced to sell. They aren't selling because they want to. They reselling because their bridge loans are about to run out and regional banks won't help them. This flood of half-finished flips and distressed rental portfolios is coming onto the market at the same time the buyer demand has dropped. It causes localized inventory shocks that lower the sales of other similar houses in the area. When a desperate investor sells a house for $400,000 to pay off a hard money lender, the appraiser sees your $500,000 house as worth $400,000. We also need to talk about how the appraisal gap is getting bigger all over the country. This is the deal killer that no one can see. In regular markets, buyers and sellers agree on a price, and banks say it's okay. Banks are scared in 2026. They know that prices are too high. They know that a correction is on the way, so they're telling appraisers to be careful. A buyer might say they will pay $600,000 for a house, but the bank says it is worth $550,000. The deal is dead. The disease is also spreading among builders. Builders use revolving credit from local banks to pay for land, materials, and labor. As regional banks pull back on lending, builders are having trouble getting money. Big public builders like Dr. Horton and Lenner are fighting ruthless mortgage rate wars to get quick cash to pay off their own debts. By paying lenders huge fees up front, they can offer mortgage rates of 4.99% when the market rate is 7%. This makes the market split into two levels. If you're a regular homeowner selling your current home, you can't offer a rate of 4.99%. You have to compete with a builder down the street who is selling new homes with lower monthly payments. You need to cut your price by a lot to be able to compete with the builder's subsidized rates. Builders are basically setting the bottom of the market, and that bottom drops every month as they offer more incentives to sell more homes. They're the ones who make the market, and right now, they're getting rid of stock to stay afloat during the credit squeeze. We are also seeing a change in the structure of the insurance market that is acting as a hidden crash catalyst. Escrow shock is hitting homeowners in states like Florida, California, and Texas who thought their payments were safe. Because of the risk of climate change and the cost of reinsurance, insurance premiums have gone up by 2 or 3 times. A homeowner may have a fixed mortgage payment of $2,000, but their escrow payment for taxes and insurance just went up by $600 a month. This makes their debt-to-income ratio very high. It makes retirees on fixed incomes and working families sell because they can't afford the monthly carrying cost. Even with a low interest rate, this completely destroys the story of being locked in. If your insurance costs $10,000 a year and your property taxes are going up, a 3% mortgage rate doesn't mean anything. The total cost of owning a home has gone through the roof, and home prices need to drop to make up for higher operating costs. Real estate investors call this an increase in the cap rate. To keep the same yield, the value of an asset must go down as costs go up. Homeowners are just now figuring out that they have to do the same math as business investors. Lastly, think about how baby boomers have given up mentally. Boomers kept their big family homes for 3 years because their stock portfolios were doing very well. Because of the stock market wealth effect, they felt rich enough to keep empty 4-bedroom homes. But as the stock market becomes more volatile in 2026, as I wrote about in my Black Monday analysis, that confidence is fading. A lot of boomers are coming to the conclusion that their home is their retirement fund. People get scared when they see prices starting to drop or when they see their neighbor house sit unsold for 6 months and then sell for less. They think back to 2008. They know that equity in real estate can go away. They'll hurry to cash out at the top to protect their savings. Boomers own almost 40% of American housing equity. So even a small change in how they feel can cause a huge wave of supply. We're already seeing more listings in neighborhoods where people are moving up in retirement homes. Experts said this supply wave would never happen. It's here. And it's filling a gap in demand that was caused by the collapse of regional banks. The 2007 moment is when all of these things came together. The CRE contagion stopped banks from lending money. Investors were forced to sell their assets. Homeowners were squeezed by the insurance crisis. And builder incentives hurt the resale market. It's a perfect storm for deleveraging. In 2007, it was subprime that set things off. In 2026, the regional bank and commercial real estate nexus will be the trigger. But the result is the same. The credit that made the bubble bigger is being taken away. When credit goes away, prices go up. The short-term rental bubble burst is the last thing that will make the housing correction in 2026 happen, at the same speed as the crash in 2008 or even faster. The Airbnb gold rush mentality messed up the American housing market for 5 years. Hundreds of thousands of investors bought homes to rent out as hotels instead of living in them. They were encouraged by low interest rates and YouTube passive income gurus. Short-term rental investors bought up 20 to 30% of all the homes in popular vacation spots like Joshua Tree, the Smoky Mountains, and the Florida Panhandle. This fake demand drove prices through the roof, making it impossible for locals to buy things and making things seem scarce. But the party ends in 2026. We are seeing what is being called the Airbnb bust. The economics of short-term rentals have changed. There is too much Airbnb supply for the number of travelers who want it. AirDNA data shows that revenue per available room has dropped by 40 to 50% in important markets since the peak in 2021. At the same time, cities all over the country are cracking down with strict bans and licensing requirements, which effectively ends the business model overnight. New York City was the first to do it, but now suburbs and HOA communities are doing it too. When a city bans short-term rentals, property values drop right away. An investor might have bought a house for $800,000 that brought in $8,000 a month in rent. But as a long-term rental or primary residence, that same house might only command $3,000 monthly rent. This leads us to the most basic mathematical fact that guarantees a crash: the rent versus buy gap. In the end, housing markets depend on how much money people in the area make and how much rent they pay. In the past, the cost of buying a home each month was about the same as the cost of renting one. The gap is the biggest it has ever been in the U.S. in 2026. Renting a typical American home will cost 52% less than buying one. This is a clear sign in the market. Housing is fundamentally mispriced relative to its actual utility. Why would a smart person pay $4,500 a month to own a home mortgage, taxes, insurance, and maintenance when they could rent the same home across the street for $2,200? No, they wouldn't. And they aren't. The group of first-time homebuyers, who are the engine that drives the whole housing market, has gone on strike. Instead, they are choosing to rent. This leaves a gap in demand at the bottom. If no one buys starter homes, people who own them can't sell them to move up to mid-range homes. If people who own mid-range homes can't sell them, they can't buy luxury homes. The whole ladder freezes up. The only way to clear the system is for the cost of buying to go down to the same level as the cost of renting. Because structural inflation makes it unlikely that mortgage rates will drop from 6 to 7% to 3%. The only thing that can change is the price. To bring back the historical balance between renting and buying, home prices need to drop by 30% to 40%. This isn't a bad prediction, it's just mean reversion. Money always wins. The Great Migration reversal makes the collapse even worse. During the pandemic, millions of people left expensive coastal cities like San Francisco, New York, and Los Angeles for less expensive Zoom towns like Boise, Austin, Phoenix, and Nashville. They brought their California salaries with them, which made prices on the secondary market go up by 50% or more. But the time for working from home is coming to an end. In 2026, companies that are going through a recession and need to cut costs are making people come back to work. They're using RTO to lay people off without them knowing it. Don't come back to work? You quit, and they don't give you severance pay. This puts the remote worker in Boise in a scary situation. They can either move back to the expensive city and sell their Boise house, or they can lose their high-paying job and find work in Boise. What is the problem? The prices of houses that Californians made are too high for Boise's economy to handle. So what's the plan? How do you get through this correction and even make money? Step 1. Accept strategic renting. For years, Americans have been taught that paying rent is a waste of money. That's not true in 2026. Rent is giving you time. Rent gives you the freedom to move around. When you rent, you're basically betting against the housing market. You're keeping your assets from losing value. You're avoiding insurance that goes up a lot. You are not paying property taxes. You're keeping your money in high-yield treasuries or gold while the house loses value. If you rent for $2,500 and the house loses $50,000 in value over the next year, this event will probably happen when the unemployment rate goes above 5% to 6%. In the past, housing prices have hit their lowest point after unemployment has reached its highest point. We're only at the start of the cycle of unemployment. Buying a house now is like trying to catch a knife that is falling while blindfolded. Step 2. Keep an eye on foreclosure data, especially pre-foreclosure filings. Right now, there are no more moratoriums on foreclosures. Banks are working through the pile of bad loans. But FHA and VA loans will really make the wave. Finally, we have to accept that the housing as piggy bank era is over. For 40 years, buying a house was a bet that interest rates would go down. It made the middle class think they were rich. That cycle is done. Because of inflation and debt, rates will stay higher than they used to be. Housing will go back to being a place to live, not a way to get rich. It will be something you buy, like a car. It costs money to own. After maintenance and inflation, it loses value in real terms. This is a good reset, but it hurts. It means that the American dream of getting rich by buying and selling homes is over. Wealth will have to be made in other places, like productive businesses, rare goods, Bitcoin, and skills. The house is just a place to sleep. Don't let that box be your grave. It's time for the 2007 moment. The metrics inventory, pending sales, affordability, and investor capitulation are all in line. The soft landing story is like getting anesthesia before surgery. The surgery is a 20% to 30% drop in the national price. It will be a mess. It will wipe out trillions of dollars in paper wealth. But for the patient, smart, and liquid investor, this will be the best chance to buy in a generation. Take your time. It's years away from the bottom, not months. Let the knife drop to the floor. Stop it from bouncing. Only then should you pick it up.